Hello, today we're going to talk about the adjusting entries. We're going to start with the first type, which is deferred expense. Now, as you know, we have 4 adjusting entries. Okay, they are classified into deferrals and accruals. Deferrals means deferred expense or deferred revenue. Now, what does that mean? Deferred expense, it means I paid in advance for this expense before it's incurred, before it's used. Deferred revenue, it means I received cash in advance before it's earned, before I provide the service or I deliver the product to the customer. So, deferred expense, I paid in advance before it's incurred. Deferred revenue, I received cash in advance before it's earned. Now, the second part is accruals. We have accrued expense and accrued revenue. Accrued expense, it means the expense is incurred, it's used, but I did not pay yet. Okay? Accrued revenue, it means the service is provided, it's earned, or the product is delivered, but I did not receive the cash yet. So deferrals means the cash was paid or received in advance. Accruals, it means I'm gonna pay or I'm gonna receive cash later. So the adjusting entries are recorded at the end of the period, and there is no cash in the adjusting entries. We have to debit an expense or credit a revenue. So for the deferred expense, adjusting entry, it should be expense on the debit side, and I need to decrease an asset on the credit side. And we're gonna see for the next slides how we're gonna do this. For deferred revenue, we're gonna have a separate video for each type. Now for the deferred revenue, my adjusting entry will be liability on the debit side, which is the unearned revenue, and service revenue on the credit side. While accrued expense, I need to debit an expense, and in the credit, because it's payable, I need to pay it later, it's gonna be a liability account on the credit side. For the accrued revenue, I need to credit revenue account, and on the debit, I need to increase an asset account, which is receivables. Okay, because I'm gonna receive my money later. Now we're gonna start with the first type, which is deferred expense. Advance payments of future expenses, treated as assets. Treated as assets until used. Recognized as an expense by an adjusting journal entry when the prepayment is used. So, deferred expense, I paid in advance before it's incurred, before it's used. So it's going to be treated as an asset until used. We have 3 examples for the deferred expense, which is prepaid rent or insurance, office supplies, and depreciation. I'm going to explain each one in the following slides. So our first example is prepaid rent or prepaid insurance. It's going to be the same thing. Now let's read this example. Paying $3,000 for rent in advance gives us the right to use the property for 3 months. So paying, it means cash has decreased because I paid. Now the accounting equation is assets equals liabilities plus equity. Assets increase on the debit side, while liabilities and equity increase on the credit side. Now I paid, so my cash has decreased. For rent in advance, so I paid in advance. It means I did not use the property yet, so it's going to be prepaid account. So also under assets. So we're going to have a second account called prepaid rent, and it has increased because I did not use the property yet. Okay, so both accounts are assets. The one who increased, which is prepaid rent, it's gonna go to the debit side because assets increase on the debit side. So prepaid rent will go to the debit side while cash has decreased, so it's gonna go to the credit side. Okay, so prepaid rent, an asset increased, cash, an asset has decreased, and the amount is 3,000. This is on December 1st. Okay, now at the end of the period, at December 31st, I need to record the adjusting entry. Okay, since I use part of this prepaid rent cause I use the property for 1 month, which is month of December. Okay, so I use the place from December 1 until December 31. So it's 1 full month. Okay, so I use this place. So what's gonna happen? It's incurred. So it's gonna be an expense account on the debit side to decrease the equity. And since I recorded prepaid rent in the previous journal entry in the previous slide, I need to decrease it now because I used part of it. So this account should be adjusted. I need to decrease this asset account. And the amount is 3,000 is for 3-month period. I use only 1 month. So I need to divide by 3. Then I need to multiply by 1. So it's going to be only 1,000. I need to find the incurred amount. The amount used. Okay, so if you look at your T accounts for the prepaid rent on December 1st, we debited 3,000 and now we credited 1,000. So you have 2,000 left. 2,000 still prepaid. You can use this property for 2 months more. While for the rent expense, you're gonna record only the amount incurred, used, the 1 month period only. Now, the second example on deferred expenses is office supplies. On November 3rd, Smart Dutch Learning purchased $500 of supplies on account. As of December 31st, only 100 of supplies remain on hand. So, on November 3rd, you're gonna record an entry because you purchased supplies on account. On account means it's accounts payable. Okay, so supplies has increased, so you're gonna debit supplies because it's an asset and it increases on the debit side, and accounts payable also increase on the credit side because it's a liability account, and the amount is 500. This is the journal entry on November 3rd. Now he's saying as of December 31st, so this is the date that we record our adjusting entries at. Only 100 of supplies remain on hand. Remain on hand means this is the ending balance. This is the ending balance for supplies. It's only 100. So how much of supplies were used? Okay, so what shall we do? We're gonna have a formula for that, which is beginning balance for supplies. I'm gonna increase it by the amount purchased. Then I'm gonna subtract the ending balance, the remaining supplies, to get the used amount or the incurred. So he mentioned nothing about the beginning, so we're gonna assume that it's 0. Purchases are 500 and ending is 100, which is the on hand. So 0 plus 500 less 100 is gonna be 400. So this is the used amount. Since it's used, so it's gonna be an expense. So supplies expense on the debit side. And an asset will go down in the credit side because it's used. So this asset should go down by 400, which is the used amount. Again, for the deferred expense, as I mentioned earlier, I need to debit an expense, and the credit I need to decrease an asset account. Now the third example on deferred expenses is depreciation on plant assets. Now what does plant assets mean? Plant assets are long-lived assets that has physical substance, so we can touch them. Plant assets are what? Are land, building, machines, equipment, trucks, automobile, and furniture. So we're gonna use them in the operations. Now what does depreciation means? Depreciation is the allocation of plant assets cost over its useful life. Okay? So all plant assets are depreciated with the exception of land. So land will never be depreciated. Okay? Now what does that mean? For example, if I buy a car today for $20,000 and I'm using this car, can I sell it after 5 years at the same price? The answer is no, because I'm using this asset. So the value for this asset will go down because I'm using this asset. So if I say that the sale price of this car after using this car for 5 years, it's gonna be $2,000. So I can sell it after 5 years for $2,000. And I bought it today for $20,000. So I'm gonna decrease the value for this car from 20,000 to 2,000. So I'm gonna decrease it by 18,000 over 5 years. So the allocation of this 18,000 over the 5 years will be called depreciation. And residual value or salvage value, sometimes they call it salvage, it's the sale price at the end of the useful life, which is the 2,000 in our example. So for this chapter, you need to know only the first type of depreciation, which is the straight line method. Straight line method, we're gonna have the same depreciation each year. Okay, so the amount of depreciation will be fixed. Now, on December 2nd, Smart Touch Learning received a contribution of furniture with a market value of 18,000 from Sheena Bright, the owner. So in this example, he's saying that the owner contributed furniture instead of cash. So they increased the capital, of this business by adding furniture to this business, not cash. So the accounting equation is assets equals liabilities plus equity. Assets increase in the debit, while liabilities and equity increase in the credit side. So he contributed or she contributed furniture. So furniture, it's under assets. Furniture will go up. And capital will increase my equity, because capital will always increase my equity, as we mentioned in chapter 1, that capital and revenues increase equity while expenses and withdrawals decrease equity. So now capital, it's positive, so it will always increase equity. Okay, so furniture will go to the debit side while capital will go to the credit side. this is journal entry. It's not the adjusting entry yet because it's on December 2nd, not the end of the period. Now, at the end of the period, at December 31st, I used the furniture for 1 month period, which is from December 2nd until December 31st. So this is 1 month period. Now I need to calculate the depreciation for this month. Using the straight line method, it's gonna be cost here less residual value divided by the useful life. So in this question he said assume the residual value will be here, the residual value of this asset is 0 and the useful life is 5 years. Okay, so the cost is 18,000 as he mentioned in the previous slide, less residual value 0 divided by 5, we're gonna get 3,600 per year, but I need only 1 month. Okay, so I need to divide it by 12 months because this is the annual. This equation is for the annual depreciation for 12 months. So I need only 1 month, so I'm gonna divide it by 12 to get the per month amount, which is 300. So the depreciation for month of December will be $300. Now the adjusting entry will be, as we said earlier, that I need to debit an expense account and I need to decrease an asset on the credit side. So here it's depreciation expense to decrease the equity, and the credit side we have accumulated depreciation. I cannot credit furniture because if I credit furniture it means it's sold. I did not sell it, I'm just using it. So I need to decrease the value for this asset by crediting a contra asset account called accumulated depreciation. It's a contra asset, it's under assets but it's credit nature, not debit nature, and the amount for month of December will be only $300. Now as we said, accumulated depreciation, it's a contra asset account. Contra asset means it's credit in nature, it's always on the credit side and it will always decrease your assets or your planned assets. So as you can see here, furniture cost is 18,000. I need to subtract its less accumulated depreciation 300 to get the 17,700, and we call this one book value, which means the value for the furniture in my books, it's 17,700. I bought the furniture for 18,000 and I use it by 300 until now, so the value for this asset it's 17,700. Same thing for the building. The cost is 60,000 and the accumulated depreciation is 250, so the book value will be 59,750. For the land, we said it's never depreciated, so there will be no accumulated depreciation for the land. Thank you for watching. If you have any question, please leave a comment. Please like, share and subscribe.